I'll hear you. I didn't hear that.
Yes, yes, yes.
Oh, okay, okay.
Good afternoon, and welcome to today's webinar hosted by the National Network of Credit and Financial Professionals. I am here today with Gerald Saad and Joel Launcher of Novus International, who will be presenting on an excursion into DSO and an examination at the countback method. A few items to get out of the way before we begin. If you have any questions during the course of the presentation, you can ask them through the questions function on your side panel. We will gather all those questions and save them for a Q&A at the end of the presentation. If you are looking for a copy of the slides, we will be sending a copy through email after the presentation is complete. The last item is that we'll have a brief survey that pops up after the webinar ends. It only takes about 30 seconds to fill out, but it gives us a lot of great information on how we can continue to make our webinars better for you. And now I'm here with Ken Frisco from the Federation of Credit, who will give you a brief bio of our speakers.
Thank you, Roxanne. Good afternoon, everybody, and welcome to today's webinar, which I'm sure you'll enjoy. I'd like to introduce both of our speakers and give you a little quick background on both their qualifications. First speaker is Gerald Saad. He has 25 years of experience in the credit industry in banking and trade finance. He's a graduate of the University of New Mexico in finance and economics, and he's also earned a commercial banking certificate from the Western States School of Banking. He currently serves as the manager of global credit at Novus International and is the team leader for its economic and agribusiness intelligence team. Next speaker we have is Joel Boncher, and he has a graduate degree in accountancy, taxation, and business management from the University of Louvain. He has been working in different multinational companies and seen all aspects from AP team leader, AR to GL. For the last 8 years, he's worked at Novus as a credit manager for Europe, the Middle East, and Africa. So with that, I'll pass it back to Gerald to start the presentation.
Thank you, Ken. Thank you, Roxanne. Good afternoon, everybody. Before we get started, I'll just give a brief overview. I'm going to discuss the subject matter at a very high level. Then I'll pass it on to Joel in Brussels, who will give you a lot more detail and a lot more detailed analysis and go through his story. And I say this a story because the title of this is an excursion into DSO. It's not a mathematical analysis. It's not a textbook study of the situation. It is. This is going to be a lot of our background, our struggles with coming to a good DSO figure, and how a good methodology works out. At the end of the day, you could decide that some of the things we discuss isn't worth your trouble. You could discover that it would be worth your time to explore some of these options. So we're just going to lay it out there. And that is one of the reasons why I invited Joel, because in North America, our DSO, our methodology, honestly could work with some very simple formulas. But when you start extending it to Joel, who is the European manager and also has Middle East and Africa, it becomes a much more complicated. So that's my ground rules. If you read those bullet points, I've pretty much covered that. But I do want to cover the fact that not only credit managers look at DSO, other people look at DSO and they have different considerations. So that might also play a little bit into not as much your methodology, but maybe the inputs you're going to put into your DSO formula. Starting with that, here are the different players I see at an organization that are using the DSO. First and foremost is the CFO of our organization. And of course, the CFO is going to be looking at the DSO from a cash flow cycle. So he's also interested in inventory turns and AP offsets to that. In essence, he wants to understand his working capital carrying costs. The treasurer always looks at DSO. Why the treasurer looks at the DSO is to look at a month-end cash projection and maybe even a forward-looking cash projection. Obviously, the sales managers have a big interest in DSO because they want to understand what kind of terms on average they're giving the customers. And of course, the credit manager, we're looking at measured collection and credit effectiveness. So with that said, I kind of summarize some points here of what the different inputs and methods each individual might look at. So for instance, the CFO might want to look at all AR, including trade and non-current. He might want to look at cash sales and credit sales. Excuse me. So, and that's important because, again, what we were discussing earlier is they're looking at the working capital carrying cost. The methodology a CFO would use would be some sort of monthly averaging. My experience is they just like to use 30 days and do the division. They're not too concerned about 31 days, 29 days, 28 days. They're just going to use a straight 30-day division. The treasurer, on the other hand, may remove cash sales from the formula and may include intercompany AR because that's cash coming into him. This would be greatly different from what a credit manager would look at. And again, the methodology they would use might be totally different than what we've discussed today because it would use the DSO to come to some sort of month-end projection and may only use 1 month of sales as a methodology. The sales manager, they may want to include cash sales as well as the credit sales. Why do I say that? Because their focus is on the average terms they're extending, and from their perspective, that includes cash customers, prepaid cash customers, as well as the customers that are on credit. I see this very frequently. I'm in another trade group that focuses on grain, and a lot of grain is sold on cash, and these companies tend to include cash sales in their DSO calculation. As a credit manager, we're going to look at credit sales. Sometimes we want to remove known bad debt, and we're going to use actual days of the month versus 30 days of the month, which can create a big difference in our adjustments in our DSO. It actually does have a big impact, the actual days. The methodology, well, that's what we're going to discuss now as we move forward. Here's just some other thoughts for the credit managers. What are considerations may be in conflict with other? Again, the actual number of days versus the standard 30-day type terms. This is a choice you're going to have to make. The idea of excluding cash sales. I'll be honest, at our company, and again, this is our story, and you can judge if you want to remove them or not, it's not material versus the time to make the adjustment. I've worked at other companies where it does make a lot of sense to remove them, but here it's just not worth the time it takes. Accounts with large prepaid cash amounts should be removed. I think this skews your DSO tremendously. With SOX, this could be a thing of the past. Technically, all those credit-only balances should be swept into some sort of liability account. How you do that, it would be your own accounting procedures. What we find here at Novus, our AR detail comes through showing those large prepaids, but from an accounting point of view, they got pulled over to the liability side. So we remove those large prepaid cash amounts. And just a little story on that is that before the days of SOX, I worked for a company, and our customers' fiscal year ends was December 31st, and they were reporting their results to bondholders. The bondholders were very interested in days cash on hand. So these customers would ask our local regions, hey, can you let us not pay you in December so we can drive up our cash reporting for the bondholders? Sure. Well, what was the exchange for that? They're salespeople. They always make a deal. They said, our fiscal year end is June 30th, and we're judged on DSO. So can you prepay us in June so we make our DSO goal? And they did. So again, I think that kind of behavior has gone with SOX, but I just wanted to throw that story out. And then we decide what to do with disputes. Now here, from our perspective in the United States, we're talking about damages, broken packages, maybe wrong quantities. As of themselves, small, but for some companies, such as a furniture company, this can in total be very significant to the operations of the company, and somehow you should decide to remove those disputes from your DSO. If not, you're aging. Many of you might have an ERP system, that once you code those short pays or invoices as disputes, they do get removed from your aging, or they don't age, and you can easily remove them from your DSO calculations. Again, that's all over the place how that works. But I'm also in favor of adjusting the known bad debt off the DSO. Maybe not necessarily your aging, that's up to you on how you treat bankruptcies and liquidations. Some companies leave them on the books until they're collected. Other people pull them into a non-current category. here at Novus, after a certain amount of time, we do pull them into non-current, but while they remain on the trade AR, we do adjust for the known bad debt. I have worked at companies where they take the bad debt out of the DSO based on some sort of reserve needs, general reserve needs and aging, and I'm not too much in favor. You might be able to give me a situation adjusting that kind of bad debt out of the calculation. The next slide, I'm not going to spend a ton of time on this. This is just the internet definition and with the visual. I would be 100% positive everybody on the call understands the DSO calculation just simply, and it's a simple formula, accounts receivable divided by the total credit sales times the number of days. However, as we discussed in the prior slides, what you decide is an account receivable, what we just talked about, disputes, bad debt, what you decide are sales, credit sales and cash sales, can have an impact on the final result. And that's really the meat of this presentation today and our journey through this. So again, when does this simple textbook DSO that we might have learned at a finance class or a credit class that we took, when does this work great? It works great when we work at a company that is a non-changing company. And here are the examples I put up here. Even with different days, this DSO for 1 month just works fine. The top example, we're extending terms of 30 days, and people are paying even if in that same month, even if it's a 29-day month, and no one has a dispute over that DSO calculation on the right column, excuse me. Even in the months where, the second example, where some AR didn't get paid because we had a short month, it bleeped up our AR for 1 month. It came in at 43 days, and it looked okay. And the next month, everybody caught up because we had 31 days, and we're all happy with our DSO calculation. Even if we use some sort of averaging method, if it's steady, it works pretty well. The average sales, the two formulas I have down there just for clarification, the daily sales average is the number of days in the period. The 3-month sales average is actually just divided by 3 months. And it does create a little bit of a difference in the formula. Obviously, the top one's slightly more accurate. Moving along, what are the shortfalls of these formulas? Well, obviously, when the company is not, hold on, I think I skipped over a slide. Let me see. Okay, no, I didn't. I apologize. What happens when the regular terms exceed 30 days? And this would be common for many companies. Well, that creates a situation that 1 month only using 30 days as your division really creates a mathematical problem here. On that column, your DSO is really 1 to 2 days behind if you look at it. If you look at month 1 and month 2, those 2 months together total up to 60 days, yet the DSO on the right says 58. Going down to the last 2 months, month 5 and month 6, the DSO would be 61 days, but yet it comes out at 60 days. So what does our response to that? Well, logically, we all know that we should average the DSO. And what's key when you average the sales, when you average the sales, is to make sure you're using a month, the number of months, number of days that matches your usual terms. So in this case, we're going to use a 2-month average sales DSO, and bingo, we really start agreeing with these numbers here to the right. It gets in green. So one of the first problems that comes up is our CFO might come to us and say, hey, Mrs. Credit Manager, why are you using 2-month sales average in your DSO? We report quarterly. Shouldn't it be 3 months? So we do what our CFO says, and we throw out a 3-month average, and voila, our DSO doesn't even look what we would expect the results to be. Why? Because we're averaging on 3 months of sales. We're using 3 months of days, and our terms are clearly 60 days or 2 months, and it throws off the calculation. And these are very high-level calculations. But now that we've moved into the sales averaging methodology, we've somewhat put ourselves into a corner. And that corner comes in is when there's a changing environment in sales, which happens. We're not a textbook company. So example number one is I took a very ridiculous high-level argument and I said, what happens if your sales grow by leaps and bounds over a quarter period, but yet your customer payment behavior didn't change? What would happen is we would see DSOs in the 50s. So, but we know that's not correct. Conversely, the opposite's true. If we were in a declining sales environment, we would get some ridiculous DSO numbers, such as 6 days DSO, but there's just no way that our DSO is 6 days. Customers are paying according to how they're supposed to pay. So what we did for Novus is we moved to the count-back method. And this for Novus was an issue because, and I'm not saying anything that isn't public information, in our market, our main product, methionine, about 18 to 24 months became very tight in supply globally, and prices hit a record high. So what happened is our DSO became overstated when prices were climbing very, very rapidly. Then what happened is the market caught up, supply and demand, and new product came on the market, new production facilities, and the price started coming back down to normal levels. Well, this created the opposite effect. Our DSO was looking very, very good, and I was trying to tell people, before I was telling them our DSO isn't as bad as it looks, and now I'm trying to tell them it's not as good as it looks. So when we moved to the count-back method, by using a layering technique, which Joel will describe later, it really took that out of the equation. So what were the immediate impacts of this? Well, LATAM called up the moment we switched over at our fiscal year, which was April 1, and said, we think there's an error in this count-back method because our DSO went up. And I said, no, it's not that. It's the fact that because prices were going down, combined with your Brazilian depression and businesses down, your DSO was understated. They went back, they talked to their CFO who had just come from another company, and he said, no, we used at our company the count back, and this is the best method. What was the second thing this helped us with? In Europe, which Joel will speak to after I finish this point, is because of the diversity of his geographic area, where you have customary terms in North Europe, which are low, Southern Europe, which about double what North Europe was, Eastern Europe, which can be 60 to 90 days, and Turkey, which can be 90 days, we were always struggling, well, what is the correct number of months or number of days to average? Is it 2 months or 3 months? Well, indeed, when prices were going up, it was 2 months. And maybe when prices were going down, it was 3 months. It just depended on the situation, and that actually probably was reversed. But we came to a decision is we're going to have to choose a methodology, and we're going to have to stick with it because it creates management red flags if we're continually changing the methodology we do to report. And given that we're pretty much stuck with 3 months averaging because of LATAM and certain Asian markets, this was a severe penalty to what we were seeing in Europe. So with that, I would like to also announce that for the Federation of Credit and Financial Professionals, this will be our first, and I'm a board member, this will be our first transatlantic broadcast. And for that, I'll shoot it over to Brussels.
Thanks, Gerald. I think you explained well. Why I think that I'm in this presentation is that, indeed, as Gerald explained, there are different ways as to measure your DSO, but in my area, we have a certain target for the area, but this area is divided in regions, and this region is even divided in sub-regions. So you also have targets for your sales organization. And what is very important is that you report in a consistent way, and that also the figures that you report, that they are explainable, and especially the differences between the months. So I was struggling at that point for the very simple reason, for Europe, Middle East, for example, Northern Europe, we have an average payment term of 30 days, Southern Europe 70 days, and Middle East 90 days. So what we saw that sometimes we had some big differences from month to month, which were hard to explain. So what I would try to do, and when we look for the most prominent and most popular measure in credit management, it's obvious the vast majority of CFOs and credit managers that they look at DSO, and even I hope also CEOs. It's a simple calculation translating the due amount to us by our customers in numbers of days. It's easy and straightforward at first sight. Useful, but on second thoughts, also to be handled by care. Why? You can turn the slide. There are indeed some critical elements to consider when we use these simple DSO definitions. Like it's not specific, it's preventive, as well as collection aspects are involved. It can be misleading in case of seasonal or evolving sales figures. You have different payment conditions, as I just explained, as to different areas. The behavior of our customers may vary with product group, geography, level of competition. It does not offer a good insight into reason of changes in some cases, like I explained, and it can be influenced by disputes. Especially in our area, Europe, Middle East, and Africa, these are all exports. So sometimes we have products which is coming from China, it's coming from the US, it can come from Spain, it can come from all over the world. So it's more complex, and you can have issues with logistics, that there is an issue with documents, there is a container blocked at the port, invoices has not been received by a customer, and so on. So this can be very technical disputes as to the export that you do, which have a big influences. And what it also does not do is it does not consider the profitability of the customer relationship. The meaning and the possible solutions for each of these problems will become clear in the next session as to the DSO measurements. Next slide. So let's just start with an easy one. In case of seasonal activity or an increasing or decreasing sales volume, there is a huge influence in these aspects as to the result that we measure. So what I try to show is that we put some conditions. Consider sales volume, 40% will be paid next month and 60% in the following month. So, and the considered sales at 500 at each of the preceding months. So the first 3 months, your sales is equal to 500. And so based on this payment pattern, you will end up by your accounts receivable balance. So we can turn the slide, Charles. So what we see here in this scenario, if you look in month 6, you have an accounts receivable of 1,060. How is this made up? This is the sales of that month, 700, plus the 60% of the sales of the previous month. And what we need to note here is that this is a constant payment pattern. So, as explained by Gerald, we use the basic DSO using sales averaging. There is, of course, an important question here. Number of periods. Which periods do you use to average? Do you use just 1 month? Do you use 2 months? Or do you use 3 months or a whole year? Does the amount of the periods influence the result? Yes, it does. It does for sure. In this example, we calculate the DSO based on sales in the last month as DSO 30, so this is 1 month. Then we measure on a 2-month average and then on a 3-month average. And then you can already see this result, which is what you see is very different with the same payment pattern. So, because at the end, what we measured is that you should achieve 48 days, and if you look then at the 30 month average, 60 and 90, that you see big differences in your calculations. Please, next slide. So we were thinking, okay, how can we exclude this problem, solving the problem of this simple DSO calculations. So at first possibility, we will use the so-called count-back DSO. The computation is a little bit more complex. What we do is, in fact, is to subtract the sales of the consecutive months from the outstanding until the balance is equal to 0. So we start by subtracting the sales of the last month from the outstanding. If there is a positive balance left, we subtract the sales of the previous month, or a fraction of it transformed in days. And so we do this, we continue to do this, until we have the whole outstanding balance to 0. So let's calculate this for month 9. If you look at month 9, you subtract the sales of the month, which is 600. So your AR balance left is 420. Compared with the sales of preceding months in the month end, you see the sales at 700. So what you need to do is the remaining receivables you divide by the 700. So this is equal to 60% of that sales of that month. So this is corresponding to 60% of these 30 days of the month. This gives you 80 days, 18 days. So at the end here, the total count back DSO is 30 plus 18 days, which gives you 48 days. You could say now, have you found the correct result or not completely? But at least what you can say here is that you have eliminated the effect of the changes in sales volume. And this we can see in the next slide. So if you now look at this count back DSO, you see this is straight on the whole line in every month at 48 days. And this is what we want to achieve. On all the others, you see differences. So here, what you see here, also the DSO 60 stays very close to that balance of 48 days. So what we want to do now is to, if we make it a little bit more complex, let me see, because here I missed my slides.
You want me to flip to the next slide, Joel?
Yes. 7. Let's see if you just extend the example with some more complexity. First of all, we will introduce a more realistic payment behavior. Unfortunately, we will often see that some of our customers do not pay their accounts within the terms that we agreed on. In our example, we had an average of 48 days, but in reality, we might have the following pattern. That you have a difference here we are going to see if, for example, 40% are paid after 30 days, 30% after 60 days, and 20% after 90 days. And for the remaining 10%, we will have to wait 120 days. So this results in a weighted average payment term of 60 days. So again, we will calculate the DSO 30, 60, 90 and the count-back DSO. Next slide. So here we can see, if you now look at this result, we can see that at the starting point, based on the constant sales that we had of 500 in the preceding month, all measure starts with the real DSO that we calculated, which is 60 days. But when we take a closer look at these results in the following months, we see that, for example, DSO 30 is showing much bigger changes. So you can imagine if, as a credit manager or credit professional who sees his performance measured by this kind of calculation, that it's very difficult to explain, and he will not be very happy about this. But we can also see that the changes are getting less prominent when the reference period is getting longer. What does it mean? It's getting closer to the actual payment term. So the count-back DSO also stays relatively close to the actual value. But also here, again, we see differences that are bigger than 2 days, which for us means a lot if you talk about DSO, if there is a big focus on DSO. Next slide. Why do we see this also in the count-back DSO? This is, of course, due to the fact that in the case of the count-back DSO, we suppose that the outstanding receivable refers to the newest invoices, which is in reality not always the case, of course. All this shows that the traditional ways of measuring DSO is not always reliable as to the performance that you want to measure. And the thing is that this will get worse when actual payment behavior really changes. You also need to remember that in these examples, we have always used the same actual payment pattern. Next slide, please. So here in the next example, what I try to do is that the payment term initially is the same as in the previous example, but as from the 7th month, payments are slowing down a little bit. So this gives us a following pattern that, like you can see on the table, the percentage payments after 30 days in the first 6 months is 30 days. In the following months, from the 7th to the 12th month, it's 30%, and the first 6 months, 40%. And so you see that in the second period, it's all slowing down. So we come up with an average payment term for the invoices in the first 6 months at 60 days, and the average payment term for invoices as from the 7th month is 64.5 days. So next slide. So if we now look at this performance, which is interesting, as we can see here that we see a very big overreaction for the DSO 30, which could be expected, but also DSO 60 is reaching here a peak of 86.5 days in month 11. The count-back DSO stays a bit closer to reality, but it still shows an important difference with this reality also in month 11 and even in month 10. You could say, okay, this could fit, any of these could fit for your own business. It all depends how is your focus, what are your targets that you want to achieve, what is your average payment term that you are dealing with. Are you dealing with small regions, big regions? But is there a better alternative? Next slide. Well, there is. It's the so-called sales-weighted DSO. It's a little bit more complicated to calculate, but it will give a result that is a lot closer to the real payment behavior of our customers. How is it calculated? It's not rocket science. The total outstanding amount of receivables is subdivided in fractions that correspond to each of the months. This will allow us to calculate the fraction of the sales of each month that is still not collected. So if you add all these days fractions, gives us the sales weighted DSO. So we have an example to explain this, and this will be in the next slide. So here you have the table with the sales by the different months and the receivables. So the total outstanding in the 7th month is 1450. Of this total amount, this is the scenario. 800 is from sales of the month, corresponding to 100% of the sales of this month, which gives us 30 days. 420 from month 6, which gives us eventually 18 days. 180 from the 5th month, which gives 9 days. And finally, we have 50 left, which gives us 3 days. So adding up all these totals, it gives us 60 days. So if we now go to the next slide to these results, so if you look at these results, you can see now that the sales weighted DSO, it changes from 60 to 64.5 days, along with the changing payment behavior, because we know as from the month 7, we will see delays in payment. You can, of course, question saying, okay, should the change not be immediate from the 7th month on? But this is not the case, because we need to understand that the outstanding in a given month is the result of the payments of several preceding months. And this is obviously not only the payment term that applies to the invoices of that month. So you see all these different things, all these different measurements. Today we at Novus, we use the countback DSO. The sales weighted DSO, we don't use it so far. We maybe have a plan to start using it in the future. The countback, it already gave us a big relief as to do our reporting and to explain the DSO development over the year, over the months that passed. Of course, I think as to DSO in general, there are some observations that I believe we should limit this calculation to credit sales. For us, the credit sales, the non-credit sales, the cash sales are so limited that it has no impact for us. Disputes, it's important, I believe, because at first sight we would decide that dispute invoices have to be eliminated from this overview, since in many cases the origin of the solutions of dispute is not the responsibility of the credit management. Of course, it's not always easy to do, but there is another problem. Not all disputes, of course, are technical disputes, and not all of them are really justified. So sometimes these disputes are used for late payment. Of course, there are other aspects as to DSO, as to collections, preventive aspects, the influence of the behavior of your customer, your regions, how you work with your sales colleagues, of course. But this was just about the different ways how DSO can be measured, and the way that you do it, if it suits for your business and for your reporting and for the targets that you need to achieve. But this well shows that, and that's important for us, is that we want to calculate something that is explainable and that is as close as it gets to the real value, so that the measurements that we take are also the real measurements that you should take. So yeah, that's it for me.
Thank you, Joel. Hey, well, thank you, Joel. And I would second your point there. We're spending a lot less time explaining the anomalies of the formula with countback and more time just talking about what's going on in the real world. Interesting in your research for this that you ran across this methodology. So I'm curious. Today, it's fairly easy in our models for DSO that we have, what we call our online calculators, to load in country sales, load in a country current and total, and get to not only this countback DSO, but our 30, 60, 90, even the credit effective index we also calculate. What would you say from a time perspective and an effort perspective would it take for us, or even any of the credit managers listening, to move over to the sales weighted average DSO?
Yeah, I think it's a good question, and especially in my situation, I'm in favor of the sales weighted DSO because I have these challenging different areas, of course. I believe it's a different way of measuring because you will need to have an aging. Normally now what we use with our agings, our AR reports that we have, is that we have these buckets as this is current, this is 0 to 30 days past due, then 30 to 60, 60 to 90, and 90 plus. But of course, if you do the sales weighted DSO, what you need is to have a DSO AR aging report starting from the date of invoice, and not starting from the date of maturity, what we have today. But I believe it's all about budget, about time. But I think if you put in the investment, and that you can even do it, or it's possible in your ERP system, or it's easy to set up in SAP if you have someone in your team or in your organization that is very well in Excel. I think it's worth the investment as to report things that are as close to the reality. Because you will have, like you stated, Gerald, you will have more time to focus on other things in different regions on customer side than monthly trying in your different areas or sub-regions to explain what happened to the DSO. And it's also better that you don't have too many peaks, because what we do in our organization, we also try to give DSO targets to our sales organization. So you need to explain well what is happening and what is influence this result. And for example, if you look at this DSO 30 and you need to explain this to your sales, yeah, they at a certain time they can say, okay, I don't need these targets because it's hard to explain and it's hard to measure, and what you measure in reality is not really correct. So I'm always in favor as to process improvement, best practice, because at the end it will benefit you and your organization, and also your cross-functionality in your organization. That's my belief.
Okay, and with that, we'll turn it back over to Ken and Roxanne.
All right, I actually have one question right now. How do you adjust for sales marketing rebates programs, which in my case is over 1/3 of my gross AR?
Oh, is it how do you do it or should you do it?
How do you do it?
Oh, how we do it today. So, Joelle, you probably deal with some rebates there. I'm thinking about our customers in Africa. And if we leave the rebates on the account, well, let me back up here. All right, I have some in NORAM. If I get a real huge rebate and it goes on the account, I do not count that in the DSO calculation. So we have some major users of our product. They hit their sales incentives and they get you know, a 7-figure rebate. I pull that out of the account DSO calculation, even if there is a debits on the account, because I know they'll take it as a cash payment. That's just what I do. Joelle, what's your thoughts on some of these rebates that you are issuing, let's say, for some of your distributors across Europe and Middle East and Africa?
Yeah, I think that you also need to consider what is the ruling on your rebates or commissions, but for us the rule here is that a rebate gets calculated at the end of a certain period related to the contract that you have, but of course this calculation, it only happens on invoices that are paid. So on the receivables that are already settled, you are entitled to get a rebate, and also the calculation only will be made the moment that these invoices are paid. So it should not be in your trade receivables in that case, because this is a credit note sitting on your receivables. Even this receivable is not a receivable anymore because you already received the payments of these receivables. So in that case, I would say it should not be in your trade receivables.
Okay.
Next question. Please explain the comment regarding calculating from invoice date versus maturity date of the invoice with regards to SWDSO.
Sales weighted.
So I'll take the first shot at that. What Joelle is saying, since you're, okay, first of all, your day sales averaging is not based on the maturity date. It's always based on when the invoice was issued. It's inferred in the DSO calculation, but in this weighted sales average, you're going to have to virtually get the days that invoice has been outstanding and put it into a bucket. I don't think I explained that too well, but it's not really a big deal. In essence, that's what we do today with DSO anyways, because it's day the sale's been outstanding, not the day it's been delinquent. Joel, do you think you can explain it a little better? I don't think I did a good job on that.
Yeah. What you do with the countback is that you take your total receivables of a total month, you know, and what you do, you bring them back, you deduct them from the sales of that month, and what is left over, you bring back to the previous month. And if there is still some left over, you again bring it to the previous month until you come to a zero balance. With the sales weighted DSO, it's a little bit different. What you want to do is that any receivable that you have in your books, that you bring this back to the exact month when the sale was executed. So if you have a receivable of 120 days past due, you should bring it back to the sale of 4 months ago. And with the countback DSO, it could also already be gone in the previous month, depending on the sales that you had at that month. So that's the difference. That you really are going to say, okay, this is a receivable, and this receivable came to life by having a sale 3 months ago. So if this receivable is still outstanding, it should go back to the sales of that month 3 months ago. And this is the big difference. So your measuring more accurate as than to the count back DSO.
All right, so at this time, there are actually no further questions. So when I send the presentation later out today, I will provide both of your email addresses, so anybody else who does have any questions for today can follow up with both of you directly if that's okay. Are you okay with that, Gerald?
No problem.
All right, well with that, we are actually going to close today's webinar. I would like to thank both of you for taking the time today to present to all of our attendees. I'd like to thank all the attendees on the line for joining us. And with that, I look forward to seeing you all at our next webinar. Have a great day, everyone.